Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, what we learned in the markets this week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week we'll focus on our key market indicators as well as continue our discussion by reviewing the contributors and detractors that impacted the market this past week. Now we'll do this all while looking at both the equity market and the bond market to really provide you a comprehensive view of the market movement and the impact to your portfolios. Now, additionally, I'd like to highlight a webinar that John Mark and I will be hosting at the end of this month. If you enjoy these videos and are looking forward to a further deep dive into macroeconomic drivers for this year, please make sure to join that webinar by clicking on our webinars link on our website. So with that, let's hop right in. Now, on to the market recap. First, each week we review the Atlanta Fed's seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 3.8% growth, which is the same as we reported last week. This projection data includes data from the U.S. Bureau of Economic Analysis, or the BEA, Institute for Supply Management, or the ISM, gross private domestic investment growth, as well as a personal consumption expenditures data, which we've discussed in the past. Next, each week we look at initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data rose by 7,000 claims, ending at 247,000, while continuing claims fell to 1.904 million. This is the highest we've seen the initial claims data in the past 8 months. It's also important to highlight here that this is a potential threshold value. And what I mean by that is as we near 250,000 initial claims and we stay there, we tend to find some associations between that value and the overall economy. And so let me give you some examples. If we remain at that level at around 250,000 initial claims, it could mean that obviously that the labor market itself is cooling. There's also been associations found to show that higher unemployment tends to be associated with the onset of a recession, and certainly the additional other economic implications that are closely tied to all of this. Now, we'll certainly watch this data very closely in the upcoming weeks and make sure to report out to all of our viewers as we see more information come together. Next, we are watching mortgage rates closely to see how home affordability is trending. This week we saw minimal movement in both the 30-year and 15-year mortgage rates again, ending at 6.89% and 5.99% respectively. Next, we'll look at investor sentiment. The latest update shows the bull-to-bear spread fell from a positive 1% last week to a negative 9.8% this week. Investors are once again starting to feel bearish again with the current market. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. Remember, the VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 are generally correspond to stable market periods. This week, the VIX ended at 16.77. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 2.6% probability of a 0.25% decrease with a 97.4% probability of no decrease here in June. The probabilities of a decrease in June continue to come down based on this data. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 1.11%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 3.03%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 0.23%. Another volatile week this week, but we are finally in the green again. And the winner for the biggest winner this week goes to, well, aggressive stocks. This was a much needed win, especially after the volatility they've seen this year. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's hop right into our discussion around the contributors and detractors of the market. Now, it was a great week with all major stock indices posted gains during this week, with S&P 500 nearing 6,000 with a 1% gain just on Friday alone, and we'll talk about that in more detail. The NASDAQ gained 1.2%, the Dow Jones gained 1.05%, and the Russell, as we talked about in the previous slide, gained more than 3%. Now, on the bond side, we saw rising yields were observed where long duration bonds sold off. 30-year touched around 5% and the 10-year touched around 4.5%. We also saw a flattened yield curve due to economic uncertainty and policy tightening. So a lot of things came together last week, but what were the key factors that drove these market changes and the market dynamics? So we'll discuss that next in the contributors and detractors section of this discussion. So let's take a look at the contributors in the market. And first, we'll start out with equities. The U.S. added 139,000 jobs in May, beating expectations. With the unemployment rate steady at 4.2%, this helped push the S&P 500 past 6,000 for the first time since February. We also saw that the Russell 2000 small cap index surged over 3%, outperforming both mid and large caps. We also saw the mega cap tech sector as well rallied again, fueled by enthusiasm around AI and strong earnings, particularly from NVIDIA that we talked about last week. As well as talking about tariffs, there was a phone call that happened between Donald Trump and Chinese Premier Xi Jinping, which offered temporary relief after renewed tariff tensions. Now, however, the market remained wary due to ongoing tariff action, trade policy uncertainty, and mixed legal outcomes. The bonds market also saw positive movement in the past week. The European Central Bank cut interest rates by 0.25% to 2%, indicating a likely pause in its easing cycle. The ECB President, Lagarde, emphasized that future rate decisions would be data dependent, and this decision boosted European bonds and triggered a global bond rally, with the U.S. Treasuries also benefiting. We also saw bond yields and investor sentiment improve. The 10-year Treasury yields rose as jobs and inflation signals shifted expectations. With the market moving up this week, we only had a few detractors that were pulling it down, but many of the remaining detractors were lingering from previous week. So specifically in equities, there was a highly public clash between President Trump and Tesla CEO Elon Musk, which escalated when Trump threatened to pull government contracts from Musk's companies. This led to a sharp 14% drop in Tesla shares, dragging down the overall markets. The risk-off sentiment rippled across tech and broader equity benchmarks. However, it didn't last very long. On the Treasury side, as mentioned previously, the ECB decreased rates by 0.25%, and which had overall beneficial movement on Treasuries. However, long duration bonds did not feel the love. The discussions around the large fiscal bill or the budget bill and Moody's downgrade of the U.S. credit rating have triggered higher long-term yields, reflecting concerns over rising deficits. And now, to summarize what we've talked through, we'll talk about the market outlook. So within the equity market specifically, markets faced a roller coaster. A policy feud rattled investor confidence midweek, but solid economic data and earnings provided a strong footing by week's end. Tech and small caps led the charge as enthusiasm around AI and robust labor figures boosted sentiment. Global policy developments like the ECB ECB cut and trade negotiations added layer dynamics. Now, despite this volatility, the market's overall tone remains resilient, supported by fundamentals. On the bonds and fixed income side, the ECB's quarter point decision led to a rally with short-term global bonds. However, the combination of tariff risk, fiscal concerns, and the Fed communications is keeping yields elevated. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, if you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching.